You know, usually when you drop a heavy weight into the ocean, you know exactly when it hits the floor, right?
Yeah, there's that definitive thud.
Right. The sand kicks up, the descent just stops. It's a very clean, undeniable physical event.
Gravity just does its job, and, the mechanics are totally predictable. The mystery's over.
Exactly. But then you step into the world of financial markets, and suddenly you're dropping that weight into an ocean with a false bottom.
Oh, yeah. False bottoms, hidden currents.
And like a bunch of people arguing about whether the water is even wet to begin with.
It's a mess.
It really is. We are looking at a market landscape right now that is honestly incredibly murky. So welcome to this deep dive.
Gotta be here.
And if you're listening to this right now, you are stepping right into the submarine with us. Our mission today is to take this massive stack of crypto market research, macroeconomic data, and bleeding edge tech updates and piece together a massive tectonic shift that's happening right under our feet.
Yeah, because we're looking at a pretty fascinating multi-layered collision here.
Right.
We've got long-term market cycle indicators flashing. We've got artificial intelligence stepping into the cybersecurity ring, and traditional finance completely rewriting its playbook to deal with, existential threats.
So we are moving way beyond just looking at the daily price numbers on your screen. By the end of this deep dive, you're going to understand why a massive chunk of Bitcoin investors being completely underwater is actually, weirdly, a bullish signal.
Which sounds totally counterintuitive, I know.
Right. And you'll also see why the biggest threat to decentralized finance isn't some anonymous hacker in a basement somewhere, but actually the traditional banks that have spent the last decade claiming to hate it.
That's the real irony.
It is. And to help us connect all these incredibly complex dots, I've got the perfect analytical mind sitting across from me. You ready to unpack this?
Yeah, let's start with the immediate reality, the macro picture, because everything else kind of flows from the underlying cost of capital, right?
Okay, lay it out for us.
So we just got the U.S. Consumer Price Index, the CPI data, and inflation printed at 4.2%.
Wow, okay.
Yeah, which is up from the previous 3.8%.
Which, on the surface, that sounds bad, right? Inflation going up is usually the boogeyman that completely spooks the markets.
It is a significant increase, sure. But here is where the market psychology gets really interesting. That 4.2% landed exactly in line with market expectations.
Oh, so no surprises.
Exactly, no surprises at all. And because the market had already priced this reality in, over 99% of the market now expects the Federal Reserve to leave interest rates entirely unchanged at the June FOMC meeting.
And just for anyone wondering why, a Federal Open Market Committee meeting matters to crypto, it's so simple, right? They decide the baseline cost of borrowing money.
Right, exactly. When borrowing is cheap, investors take risks on, volatile assets like Bitcoin.
And when rates stay high, that liquidity just dries up.
Yeah. And the probability of a rate hike in July is currently sitting at barely a blip.
Okay, let's unpack this. So with interest rates essentially frozen in this holding pattern, the spotlight pivots directly to Bitcoin's internal metrics.
Right.
And this is where we get into some really compelling research from K33, which is a prominent digital asset research firm, and also analysis from Benjamin Cowan, who models these macroeconomic crypto cycles.
Yeah, Cowan's work on this is great.
They're tracking this critical historical indicator. It's called the supply and profit versus loss chart.
Yeah, and this is probably one of the most reliable cyclical indicators we have. What it basically tracks is the percentage of all circulating Bitcoin that was last moved at a price higher or lower than the current price.
So it's basically a literal snapshot of market pain.
Exactly. It shows who is hurting. And right now, over 50%, specifically around 51% of Bitcoin circulating supply is sitting at a loss.
Wait, so more than half of the Bitcoin in existence is held by people who are technically in the red?
Yes.
Wow. So if you bought in over the last several months, you're likely really feeling that pressure right now.
Oh, absolutely. The lines on the chart tracking profit and loss have literally just crossed. But look at the historical precedent here. This exact crossover happened in the 2011, 2018, and 2022 bear markets.
Okay, and what happened then?
In every single one of those instances, the absolute definitive market bottom occurred roughly 1 to 4 months after that 50% threshold was breached.
1 to 4 months. Let's zoom in on 2022, actually, because that wasn't that long ago. What was the exact sequence of events there?
Okay, so in 2022, those profit and loss lines crossed briefly in June. Then they uncrossed as the market rallied slightly, which, faked out a lot of traders.
Well, the classic fake out.
Right. Then they crossed again in September before the ultimate rock bottom low hit in November. So if we apply that same 1 to 4 month window to our current crossover, it puts the potential bottom window somewhere between right now and October.
There is always a catch, though, right? It's never just a gentle glide down to the bottom.
No, definitely not. History shows us there's almost always one final washout, like a massive capitulation event. Typically, this final plunge represents a drop of 15% to 26% lower than the price Bitcoin was at when that 50% threshold was first crossed.
Ouch. So what's the expectation right now?
The consensus outlook right now expects a short-term consolidation phase, hovering somewhere between $61,000 and $65,000.
Okay.
And once that exhaustion sets in, the expectation is a drop to $55,000. But the ultimate macro bottom target, the thud on the ocean floor, is sitting in the $48,000 to $50,000 range.
That's assuming, of course, no major systemic black swan events happen.
Right, yeah.
I'm thinking of something like a catastrophic break with Michael Saylor's massive corporate Bitcoin strategy.
Yeah.
Like, for those who don't follow corporate treasury mechanics, Saylor's company uses heavy corporate debt to buy billions in Bitcoin.
Yeah, which is a highly leveraged bet.
Exactly. If the price drops to a catastrophic level, it carries theoretical liquidation risks that could just flood the market with forced selling.
Yeah, that risk always exists in the background. But, keep perspective on the cycles. In prior cycle bottoms, the supply and loss peaked somewhere between 54% and 64%.
And we're at 51% right now.
Exactly. That tells us an unprecedented systemic crash isn't necessarily imminent. We are well within the normal historical bounds of a cycle bottom.
So what's the takeaway here for the listener?
The simplest, most historically proven takeaway for anyone trying to navigate this: start dollar cost averaging from the June low, accept the reality that the fourth quarter might be temporarily painful, and just hold your position.
It makes me think of this indicator like a brutal game of financial musical chairs.
Right.
Like when more than half the players are underwater, the tourists who bought the tap, they already folded. Only the stubbornly convicted are left.
Right.
But I have to push back here.
Go for it.
If literally everyone is looking at this exact chart and everyone expects a final 15 to 26% washout drop to hit that exact 48K to 50K range, doesn't that just become a self-fulfilling prophecy? Or conversely, do markets usually surprise the consensus when everyone is waiting by the door for the exact same entry point?
I have to stop you right there, because retail psychology rarely outsmarts on-chain mathematics.
Really?
Yeah. You might assume that if everyone expects 48K, institutional buyers will just front-run it and step in at 52K, preventing the washout.
That's what I would think, yeah.
The reality is that capitulation events aren't driven by rational planning or spreadsheets. They're driven by sheer panic and algorithmic trading.
Oh, right, the bots.
Exactly. When that 15% drop starts, automated stop losses trigger. Liquidations cascade. The narrative violently shifts. Suddenly, 48K doesn't look like a discount anymore,
Yeah, social media starts screaming that it's going to 30K.
Exactly. Fear paralyzes the very people who claim they were just waiting to buy the dip. That mathematical washout works every single cycle, regardless of who claims to see it coming.
So what does this all mean for the broader ecosystem? I mean, it means if the market is indeed scraping the bottom and preparing for a massive influx of capital in a new cycle, the infrastructure holding all this money needs to be absolutely bulletproof.
And historically, it hasn't been.
Not at all. The crypto industry loses billions of dollars annually to smart contract exploits, bridge hacks, security breaches, which brings us to a massive technological pivot happening behind the scenes.
Yeah, because while the markets consolidate, the underlying technology is experiencing a major breakthrough. Anthropic has just officially launched a brand new AI model called Claude Mythos 5.
And we need to be crystal clear on what this is. This isn't just another conversational chat bot that, writes your emails or summarizes your meeting notes.
Oh, far from it. Mythos 5 is a highly specialized, incredibly powerful tool built specifically for cybersecurity. According to the early tests in the documentation, it can autonomously hunt down software vulnerabilities, manage complex security architecture, and this is the mechanism that really changes everything. It can simulate sophisticated cyber attacks with almost zero human intervention.
That's insane. Think about what that means for crypto. Imagine deploying this AI to audit thousands of lines of smart contract code in seconds before they even launch.
Yeah.
Or having it constantly monitor decentralized finance protocols to detect a vulnerability before a hacker even spots it. It could theoretically plug the multi-billion-dollar holes in the industry ship.
It could.
But here's where it gets really interesting and maybe a bit terrifying.
Yeah, because the fundamental nature of cybersecurity is a perfect mirror, right? The mechanics of defense and offense are literally identical.
Explain that.
Well, to know exactly how to patch a zero-day vulnerability in a smart contract, you have to know exactly how to weaponize and exploit it. So the exact same AI capability that helps a white hat defender secure an exchange can be utilized by a black hat hacker to supercharge a devastating attack. Mythos 5 doesn't just point out a bug, it understands the logic required to drain the funds.
Wow. And Anthropic clearly realizes they've essentially built a digital weapon, right? Because they've put massive guardrails on it.
Oh yeah, huge guardrails.
They are strictly restricting access to Mythos 5, only allowing approved cybersecurity organizations, enterprise firms, and verified researchers to log in.
Yeah.
If you're just the general public, Anthropic has released Claude Fable 5, which is essentially a nerfed version with hard-coded guardrails that absolutely refuse to process sensitive cybersecurity requests.
Right, which is just a basic containment strategy. Anthropic is basically trying to give the defenders a head start by keeping the most capable model out of the hands of malicious actors.
I look at this like inventing a completely unbreakable lock, but the lock inherently comes with a master key. And Anthropic is trying to keep the master key locked in a vault.
That's a good way to put it.
But here is my pushback. If the public only gets the heavily censored Fable 5, won't road hackers just build or, fine-tune their own uncensored open source AI models?
Of course they will.
Right, because they don't need Anthropic's permission. Aren't we just setting up the crypto world to play an endless automated game of whack-a-mole against AI-driven botnets that just never sleep?
That's the reality we're facing. Open source AI models are becoming incredibly capable, and malicious actors are absolutely going to train uncensored models on vast databases of known zero-day exploits.
So the guardrails are just temporary.
Yeah, the gatekeeping of Mythos 5 is a temporary speed bump. It's not a permanent solution. What we're really witnessing is the dawn of autonomous cyber warfare.
That sounds like a sci-fi movie.
It really does. But eventually, human auditors won't be able to keep up at all. It will literally be AI defending DeFi protocols against AI, attacking them, identifying exploits, executing attacks, and deploying patches all in a matter of milliseconds.
Okay, so if artificial intelligence is going to secure the underlying code of crypto, it brings us to a much broader battle.
Yeah.
Because the biggest existential threat to the open, permissionless ethos of crypto right now isn't actually coming from automated hackers.
No, it's not.
It's coming from the very institutions crypto was originally designed to bypass the traditional banks.
Right. And if you look at the analysis recently put out by Coin Bureau, there has been a massive institutional pivot.
The huge pivot.
For years, traditional finance mocked crypto. Then they actively lobbied against it. And now they are actively absorbing it. They are racing to build massive infrastructure for crypto custody, for stablecoins, and for tokenized real-world assets.
And we're talking about the absolute titans of Wall Street here. BNY Mellon, Morgan Stanley, Fidelity, SoFi, and these massive European banking consortia. They're all building the pipes for crypto. But why the sudden change of heart?
The motivation is pure self-preservation. You really have to understand the core mechanics of how a bank makes money, right?
Right, break it down.
They rely on fractional reserve banking. They take your deposits, keep a tiny fraction on hand, and lend the rest out for profit. So when you take $1 out of your traditional checking account and use it to buy a stablecoin like USDC,
that dollar literally leaves the bank's balance sheet.
Exactly. It moves to the stablecoin issuer's reserves, like treasury bills. That is a direct existential threat to the bank's fundamental funding mechanism.
So if you're a listener holding your savings in USDC to farm yield and DeFi,
yeah,
every single dollar you hold, there's a dollar a traditional bank can no longer leverage.
Right. They're bleeding capital.
Wow.
And to combat this massive capital flight, institutions are creating their own highly controlled walled gardens. Look at JP Morgan. They created their own blockchain-based tokenized deposits known as the JPMD token.
Oh, right. JPMD.
Yeah. And on the surface, it uses blockchain technology, so it feels fast and modern. But fundamentally, the mechanism is designed to keep the funds trapped securely inside the traditional banking system. JP Morgan gets the efficiency of a blockchain, but they never actually lose custody of the deposit.
And this battle isn't just playing out in, product development labs. It's a full-on regulatory war.
Oh, absolutely.
The banks are heavily supporting rules that would prevent decentralized stablecoins from paying yield to users, while simultaneously opposing any legislation that would allow crypto-native firms to directly compete for banking deposits.
Yep.
We see this right now with New York's newly proposed stablecoin regulations aligned with the Genius Act.
Right, the Genius Act.
For those unfamiliar, this is a legislative proposal that sets incredibly strict reserve concentration limits and massive compliance standards. It effectively builds this regulatory moat that heavily favors massive established financial institutions while completely suffocating smaller, decentralized competitors.
And the strategy is global, too. Over in Japan, the megabanks institutions like MUFG, Mizuho, and SMBC, they are explicitly targeting the launch of live stablecoin transactions by March 2027, built entirely on their own institutional rails.
It reminds me of a Blockbuster video store. Imagine if Blockbuster had successfully bought out all of the streaming technology and just patented it before Netflix could even get off the ground.
Oh, man.
They wouldn't have innovated, right? They would have just turned streaming into a more efficient way to charge late fees.
That's a great analogy.
Let me ask you this pointed question, though. The original cypherpunk dream of Bitcoin was an open, permissionless alternative to banks. If JP Morgan and these Japanese megabanks end up controlling all the tokenized deposits, all the custody, and the regulatory infrastructure, does blockchain actually create a more open financial system? Or is it just a highly efficient, hyper-fast new version of the exact same banking system?
I mean, the historical parallel here is institutional capture. Technology itself is completely agnostic, right?
Right.
A blockchain protocol doesn't care if it's run by a cypherpunk or by a Wall Street banking executive. If the regulatory moats get too high, the crypto that you interact with 5 years from now might just be a slick user interface plastered over the exact same legacy banking rails.
Which is pretty depressing.
It will definitely be faster and cheaper to settle transactions, but permissionless, uncensorable. That original ethos is under severe threat of being regulated completely out of existence.
But, the decentralized ecosystem isn't just sitting still, rolling over, and letting the banks build these regulatory walled gardens.
No, they're fighting back.
Exactly. Decentralized finance, or DeFi, is actively upgrading its own infrastructure to compete on an institutional scale. They're basically trying to prove they don't need the banks to be safe or efficient.
Right, and we are seeing massive maturation in these protocols, particularly with the OV. It's one of the largest decentralized lending protocols in the world, and they recently unveiled a drastically tougher risk management framework.
And this wasn't just some random upgrade, right? This came directly on the heels of the massive Kelp.do exploit.
Yeah, that was brutal.
For the listener who doesn't track every single DeFi hack, Kelp.do involved a critical loophole in a liquid restaking protocol. Hackers essentially found a way to manipulate the pricing mechanism of tokenized assets, allowing them to drain nearly $290 million from the system.
It was a huge hit. And in direct response to that exploit, Gave is implementing much stricter asset listing requirements and tightening the security demands on cross-chain bridges.
So they're stepping up.
Yeah, they're raising their internal standards to resemble the rigorous risk management you would expect from a traditional financial institution.
Mhm.
But the mechanism of how they do it is what really matters.
How so?
This isn't a CEO making a unilateral decision behind closed doors. This is executed through decentralized governance.
Okay, break down how that actually works for us. How does a faceless, decentralized protocol act like a bank risk manager?
It works through tokenized voting. So the people who hold ABO's governance tokens, they actively vote on proposals to freeze certain volatile assets, adjust collateral ratios, or rewrite the parameters of the smart contracts.
Wow, so it's community-driven.
Exactly. Once the vote passes, the code automatically executes the changes across the entire protocol. It is programmatic, community-driven risk management.
It's not just about mitigating risk either, is it? It's about aggressively expanding what DeFi can actually do. Which brings us to Pyth.
Oh, yeah, Pyth.
They just launched a massive update, 247 pricing indices for equities, commodities, and metals.
And this represents a monumental leap for market infrastructure. I mean, the traditional stock market operates on this rigid Monday to Friday, 9 to 5 schedule, right?
Right.
It closes for bank holidays. It's a legacy system based entirely on the fact that human traders need to sleep and commute.
So how exactly does Pyth bypass that? Because blockchains are inherently blind, right? A smart contract doesn't naturally know the price of Apple stock or gold at any given moment.
No, it doesn't. Pith solves this by acting as a decentralized oracle network. They have built an infrastructure where vast networks of spatialized data providers pull off-chain pricing data from traditional markets and push it onto the blockchain in milliseconds.
No.
Yeah, this continuous real-time data feed creates the underlying architecture required to support round-the-clock trading of tokenized real-world assets.
It's a direct aggressive challenge to Wall Street. Because, why should you wait until Monday morning at 9:30 a.m. to react to earnings news that broke on a Saturday night?
Exactly.
Pyth is enabling always-on markets outside of traditional banking hours, but let me challenge you on the AVIV point for a second.
Okay.
You called it maturation.
Oh.
But is this new, tougher risk framework a genuine sign that DeFi is finally capable of self-regulating? Or is it just a reactive, panicked Band-Aid applied only because they were humiliated by a $300 million exploit?
Look, pain drives maturity in every financial system in history. Traditional banking regulations weren't born in a vacuum of good intentions, right?
True.
The FDIC and the SEC were born out of the ashes of the Great Depression and massive catastrophic bank runs. Patching its vulnerabilities and tightening its bridge requirements after a $290 million loss is exactly what structural maturity looks like.
Okay, fair point.
The distinct difference here is that Aave is doing it transparently, out in the open, via open source code, rather than through closed-door lobbying in Washington.
Yeah, that is a huge difference. Taking a step back and looking at the incredible journey we've just been on today. We started by looking at the ocean floor, understanding how more than 50% of the Bitcoin supply being underwater historically triggers the mechanics of a macro bottom.
Right, with our crosshairs on that 48K to 50K target range.
And then we explored how the incoming wave of capital will be secured or potentially threatened by Anthropic's Claude Mythos 5, which is kicking off a frankly terrifying automated AI arms race in cybersecurity.
Yeah, we're entering a whole new era there.
And from there, we watched traditional giants like JP Morgan and the Japanese megabanks try to co-opt blockchain technology, trapping liquidity to protect their balance sheets and maintain their grip on your deposits.
The empire strikes back.
Exactly.
Yeah.
And finally, we saw DeFi throwing punches back, with Aave using decentralized governance to toughen its risk models, and Perth utilizing Oracle networks to lay the groundwork for a 24-hour tokenized stock market.
The through line connecting every single one of these developments is the violent collision of cutting-edge tech and legacy power.
It really is. And it leaves me with one final thought for you to ponder, something we haven't even explicitly touched on yet.
Let's hear it.
If Perth's Oracle networks successfully bring traditional assets like equities and commodities onto a 24/7 blockchain rail, and if AI models like Mythos 5 eventually become smart enough to flawlessly secure those networks and autonomously execute complex trading logic, what happens to Wall Street's human brokers?
Oh, wow.
Yeah, the guys in the suits on the trading floor shouting orders. We might be rapidly approaching a future where not just the banks, but the entire stock exchange itself is completely replaced by autonomous code that never sleeps.
The weight drops to the ocean floor.
But there are no humans left to hear the thud.
A fascinating possibility to end on.
Thanks for coming on this deep dive. We'll see you next time.